A teacher, Ohio, regular salary, nothing special. She never picked a single stock, never called a broker. She just set up an automatic transfer of $500 a month into one boring fund and forgot about it for 30 years. She retired with just over $1.1 million. While she was quietly doing that, most people were doing nothing, watching, waiting for the right moment. That moment never came. Let's break down how this machine actually works and why it's been running without you. Quick note up front, everything here is education, not financial advice. Now let's get into it. Let's be honest for a second. When most people hear stock market, something in their brain goes, that's not for me. Maybe it feels like a club you weren't invited to. Maybe you've even tried to read about it once and closed the tab 3 minutes later. I get it. So let's start with a pizza shop. Your neighbor opens a pizza place. Best pizza in the neighborhood. Business is exploding. She wants to open 10 more locations across the city. Problem? She needs $500,000 to do it. The bank says no, so she does something clever. She cuts the business into 1,000 equal slices, like a pizza, and sells each slice for $500. You buy one. Now you own 1/1000th of every pizza sold, every delivery, every Friday night rush. If business doubles, your slice doubles in value. She gets her $500,000, you get ownership. That's a stock. The stock market is just an organized place where millions of these slices change hands every single day. Instead of your neighbor's pizza place, it's Apple, Amazon, Microsoft, BHP, Barclays, Royal Bank of Canada. Companies enter the market through something called an IPO. That's when a business first sells its slices to the public. After that, those slices trade every day on exchanges: NYSE and NASDAQ in the US, LSE in London, ASX in Sydney, TSX in Toronto. One thing to get straight right now, buying a stock is not gambling. You are buying a real piece of a real business. That changes everything. There are two ways money comes out of the market. Most beginners only know about one, the obvious one. The price goes up. You buy a pizza shop share at $500. A year later, it's worth $750. You sell. You pocket $250. Simple. But here's the second one. And this is the engine that quietly built more wealth than anything else in the last 100 years. Imagine you own a vending machine. You bought it, you placed it in a busy office building, and now every week people feed it quarters. You don't go there, you don't restock it yourself. The quarters just pile up and someone sends you a check. That's a dividend. Many companies take a portion of their profits every 3 months and send it directly to shareholders. Cash into your account. No selling, no effort. You just own the stock and the money shows up. Now here's a name you should know. Coca-Cola. They started paying dividends in 1893. 1893, through 2 world wars, through the Great Depression, through the dot-com crash, through 2008, through a global pandemic, every single quarter they sent shareholders a check for over 130 years without missing once. Companies that have raised their dividend every year for 25 years or more are called dividend aristocrats. Sounds ridiculous until you look at the track record. Then it stops being funny. And once you pair dividends with what we're about to talk about, the math starts doing something uncomfortable to people who haven't started yet. Go to your supermarket, grab a basket, fill it with the same things you bought in 2004. Milk, bread, eggs, chicken, coffee. That same basket today costs roughly 80% more. Your savings account paid you maybe 0.3% last year. So here's what's actually happening to that $10,000 sitting in your savings account. The number on your screen stays exactly the same, but every year, quietly, invisibly, it buys less. 20 years from now, that $10,000 could buy you what $6,000 buys today. The number didn't move, the world did. This is why the stock market isn't optional for most people. It's the only tool that keeps your money running faster than inflation. Keeping it in cash isn't safe. It's a slow, guaranteed loss, dressed up as safety. Now, the market doesn't go up every year. It drops, sometimes badly. The S&P 500 has fallen by 20% or more roughly 9 times since 1950. Maybe 2022 is what you remember. Or the COVID crash of March 2020, when in 30 days the market lost a third of its value. The floor disappeared and then came back within months, higher than before. Here's what most people get completely backwards. They think that danger is being in the market during a crash. The real danger is being out of the market when it recovers. Think about it like a bread oven. The oven runs 24 hours a day. Most of the time, it's just warm, ticking along. But a few times a year, it hits peak temperature, and that's when the bread actually rises. If you opened the door and walked away during those exact moments, your bread is flat. Doesn't matter how long you waited before or after. Research from Putnam Investments tracked S&P 500 returns over 15 years. Stay fully invested every single day, you capture the full return. Miss just the 10 best trading days of those 15 years, you lose nearly half your gains. Gone. 10 days out of 3,750. Nobody knows which days those will be. Nobody. This is exactly why the teacher from Ohio won. She didn't watch the news. She didn't sell when 2008 made everyone panic. She didn't try to time anything. She just kept transferring $500 every single month and let time do the math. That strategy has a name: dollar cost averaging. Here's how it works. Imagine you buy coffee every Monday morning, 1 cup, no matter what. Some weeks, coffee costs $5. Some weeks, there's a special and it's $3. You don't wait for the perfect price. You just buy your Monday coffee. Over a year, you've paid a natural average. Never the highest, never the lowest. That's exactly what dollar cost averaging does with your investments. You put in $500 every month. When the market is up, you buy fewer shares. When the market drops, your $500 buys more shares at a discount. Over time, it averages out, and you stop obsessing over the right moment to invest, because the right moment is always, every month, without thinking. The S&P 500 has historically averaged around 10% annually in nominal terms, though past performance doesn't guarantee future results. Run $500 a month through that for 30 years, and you get just over $1.1 million. That's the number from the beginning. That's how she did it. That's why this machine has been running without you. Now you know how to catch up. Everything in this video is educational, not financial advice. Talk to a licensed professional if you need to. Here's where to begin. Step 1. Open a tax-advantageous account. Think of this like a special container for your investments that the government has agreed not to tax or to tax less. In the US, a Roth IRA or a 401k. In the UK, a stocks and shares ISA. In Canada, a TFSA or RRSP. In Australia, your super is already doing a lot of this work automatically. Open the container first, then put things inside it. Step 2. Many long-term investors start with a broad index ETF. Think of an ETF like a grocery bundle. Instead of choosing one item, you get a basket of 500 companies in one purchase, one fell swoop. If one company tanks, 499 others are still running. Something like VTI or VOO in the US, or a local equivalent wherever you are. Step 3. Automate it. Pick an amount, set a recurring monthly transfer. The exact amount matters less than the habit. $100 a month beats zero every single time. Then stop watching the news and let it run. The market isn't a room full of insiders you'll never get into. It's a system. You've just been standing outside it when the door was open the whole time. The teacher from Ohio wasn't lucky. She wasn't a genius. She just started and didn't stop. If you want to know how to split that $500 across 3 funds and never think about it again, that's exactly what the next video covers. It's right there.